Welcome back to Let's Invest with the ASX. This video will cover some of the benefits and risks associated with share investing. Some of the main benefits of share investing include capital growth, income, and franking. Capital growth is the increase in the value of an investment or asset over time. It is driven by demand and favorable market conditions. Many investors aim for capital growth as part of their long-term investment strategy. Income from shares comes in the form of dividends and cash distributions to shareholders. It's important to note that companies are not obligated to pay dividends. However, Australian companies tend to pay higher dividends compared to other regions. Dividends represent cash payments made by profitable companies to shareholders, which are a portion of the company's earnings distributed to them. Distributions, on the other hand, are broader and can include both cash and non-cash payments to shareholders. This may include dividends, stock dividends, bonus shares, or non-cash assets. Let's talk about franking. Franking is a system used in some countries, such as Australia, to eliminate double taxation on dividends. Companies attach franking credits to dividends they distribute to shareholders. These credits represent the amount of tax the company has already paid on its profits. Shareholders can use franking credits to offset their tax liabilities. Individuals on lower marginal tax rates may be eligible for a refund if their franking credits exceed their tax liability. Franking is intended to promote investment in domestic companies and encourage shareholders to reinvest dividends back into the economy. Imputation credits are tax credits attached to dividends in a franking system, allowing shareholders to offset their own tax liabilities with the taxes already paid by the company. Dividend reinvestment plans, DRPs, allow shareholders to receive their dividends as additional shares. DRPs eliminate the need to pay brokerage fees for the transaction. They can be a cost-effective way for companies to raise additional funds from satisfied shareholders and for investors to grow their share portfolios. However, careful record-keeping is required when participating in DRPs. By owning shares in a company, shareholders share in the company's success through rising share prices and dividends. Shareholders may be entitled to regular performance reports, participation in company meetings, and special share issues. It is important to understand the rights attached to the shares that one intends to purchase. Public companies are legally obligated to produce an annual report that discloses their performance and future plans to shareholders. The components of a financial report include the balance sheet, assets and liabilities, income statement, revenue and expenses, statement of changes in equity, and cash flow statement. The Annual General Meeting, AGM, is a meeting held by the company where the annual report is presented to shareholders. Shareholders have the option to attend the AGM in person or submit a proxy form to vote on their behalf. Companies may offer electronic alternatives, such as live streaming the AGM online and enabling shareholders to vote using their smartphones. We have covered some of the benefits of share investing. Now let's talk about some of the risks. Capital loss. This occurs when the value of an investment or asset decreases compared to its initial purchase price. Market downturns, poor company performance, or unfavorable economic conditions can cause capital losses. However, capital losses can offset capital gains for tax purposes, reducing the overall tax liability. If a company goes out of business, it is delisted or removed from the ASX. Liquidation refers to the process when a company winds up its operations and sells off its assets to pay off its debts. During liquidation, the company's assets are distributed to creditors and shareholders. Shareholders usually receive their share of remaining assets only after creditors' claims have been satisfied. Volatility risk is the potential for large or rapid price fluctuations in an investment or market. High volatility can lead to significant gains or losses in a short time, increasing investment risk. Volatility is influenced by market conditions, economic indicators, investor sentiment, and geopolitical events. Investments with higher volatility typically have greater potential for returns, but also carry higher risks. Volatility risk can be managed through diversification, hedging strategies, and careful risk assessment. Timing risk is the speculation that an investor enters into when trying to buy or sell a stock based on future price predictions. It is the potential for missing out on beneficial movements in price due to an error in timing. Understanding business cycles and how different companies perform during the different phases of the business cycle may help investors manage the effects of timing risk. Legislative risk refers to the potential impact of changes in laws, regulations, or government policies on share investments. Changes in legislation can affect taxation, corporate governance, industry regulations, and investor rights. Legislative risk can arise from both domestic and international changes in laws and regulations. It can create uncertainties and may require investors to adjust their investment strategies or consider alternative investment options. Engaging with financial professionals, attending shareholder meetings, and participating in advocacy groups can help investors stay informed and potentially influence legislative developments. Currency risk exposes international investors and businesses to potential gains or losses due to fluctuations in currency values. Exchange rate fluctuations affect the ability to convert foreign earnings into the local currency. Individual or personal risks include job loss, injury, and domestic changes like marriage or divorce. These factors can have an impact on an individual's financial situation and investment decisions. It is crucial for investors to educate themselves on risks and thoroughly comprehend the risks associated with any investment. Understanding and managing risks is essential for successful investing. Remember to check your learning with our flashcards. Thanks for watching. Don't forget to like and subscribe for more valuable content.